So in the last class, we have completed with the question number 12. So now we are move to the question number 13. Okay. Let's see what is exactly the question number 13 here. So the question number 13 is like where we need to calculate the value of the firm here, right? So it is not about like decision making. It is like what is the value, the value assessment. As you said, like when you go for any due diligence, right? So we require to know what is the value of the firm, right? So to know the value of the firm here is in a situation where you need to assess the value. When you say when you want to value the firm, right, there are the different methods. So right, one can be use a relative valuation method to know the value of the firm, or you can use a discounted cash flow method to value of the firm here. So here with the given data, we will try to value the firm here. So what is that the given data here, right? So the data that has been given, the problem here is the free cash flows of a firm is projected to grow at a compounded annual growth rate of 20% for the next 5 years. So what they say is company's free cash flows. When you say company's free cash flows, those cash flows which are being free from the interest, tax, depreciation, right? It is completely which is belongs to the shareholders, what we call as the earnings, right? So that is earnings after tax, EAT. So that is what we call as a free cash flows. So this free cash flow on year, it is going to grow at a 20% per annum for the next 20 years, right? And then the growth rate is expected to slow down to normal growth rate of 10%. It means the first 5 years, the growth rate is going to be the 20%. After 5 years, the growth rate is comes to the 10%. After 5 years, the growth in the cash flows, it is going to grow at a 10% per annum. The current year cash flow for the firm is 5 lakhs. So currently we are received, the firm has been received 5 lakhs, and every year on 5 lakhs there is a 20% growth for the next 5 years, right? So that is compounding. Fine. So after 5 years, what happens? The sixth year growth would be the 10% on the fifth year cash flow. Fine. And the firm's cost of capital during the high growth period is 15%. The cost of capital for the firm, right? Overall cost of capital is 15% and 12% beyond 5 years, right? For the first 5 years, the cost of capital is going to be the 15%. Then after fifth year, the cost of capital comes out to be 12%, and the growth stabilizes. Calculate the value of the firm. The simple thing, what we might have been done this in your third semester with respect to investment management, where you calculate the value of the firm, right? So when we have the future cash flows, the first we need to predict the future cash flows first. So once the future cash flows are been predicted, then we need to convert the future cash flows to the present value at the given required rate of return. So once the future cash flows are converted to the present value, then you need to add up all the present value of the future cash flows. Once you add up, right? So that is a step 2. And the third step is you need to calculate the future selling price of the firm. So what we call here is a terminal value of the firm that you need to calculate at the end of the fifth year. That is, we used to calculate for end of the first year P1, P2, P3, P4. Like at the end of the fifth year, if you want to calculate, so that is we take P5. P5 is equals to D6 divided by R minus G we do. Similarly, here terminal value at the end of the fifth year is equals to future cash flow for the year sixth year divided by R minus G. So you will be getting the future selling price of the firm, then convert the future selling price to the present value of the firm, right? So then add up the present value of the dividend, present value of the selling price, where it is going to give you the future value of the firm, right? So let's proceed to trying to know how exactly that we can proceed in terms of calculating the future cash flows, right? So future cash flows presently which has been given as 5 lakhs, right? So growth rate is 20% for the first 5 years. Then growth rate is going to be 10% for infinite number of years. Then the cost of capital, the cost of capital is 15% for first 5 years. Then it is going to be the 12% forever. Then calculate the value of the firm. Fine. So coming to the first thing, currently the future cash flows are 5 lakhs. Then we need to calculate for the next 5 years. The first step would be calculation of the present value of the future cash flows, right? To calculate the present value of the future cash flows, first we need to know what are the future cash flows, right? Once you know the future cash flows, then it is very easy for you to calculate the present value of the future cash flows, right? So first we will calculate the future value, cash flows. To calculate the future cash flows, first column you take as a year. So first column heading you write as a year, then write down year 1, 2, 3, 4, and the 5. So first column is year column, and the second column would be the future cash flow, right? So the future cash flow for it is a first year cash flow. So first year cash flow, the current cash flows is 5,000. So first year cash flow, it is going to grow 20%. So 5 lakhs multiplied by 1 plus the growth rate G, right, to the power of 1. Fine. So 20% is a growth rate. I will take it as 1.1 plus 0.20 to the power of 1, right? Multiplied by 5 lakhs, it is going to give me as a 6 lakhs. Similarly, if I want to calculate for the second year, the second year growth rate, if I want to calculate, hence the growth rate is the same here. So what I will do is 5 lakhs multiplied by 1.20 to the power of 2, right? So when I take it this, I'll be getting 7,20,000 for the second year. Then comes to the third year, I have a 5 lakhs multiplied by 1.20 to the power of 3. I'll be getting the future cash flows as 8,64,000. Then for the fourth year, if I have 5 lakhs multiplied by 1.20 to the power of 4, right? So I'll be getting as 10 lakh 36,800, right? Then coming to the fifth year, that is 5 lakh multiplied by 1.20 to the power of 5. I'll be getting as 12 lakh 44,160, right? So these are my future cash flows, right? The current cash flows is 5 lakhs. When the future cash flow, the first year I applied the product of 1 plus g to the power of 1, 1 plus g to the power of 2, 1 plus g to the power of 3, then 1 plus g to the power of 4, then 1 plus g to the power of 5. By applying the formula, I got the future cash flows, fine. So once the future cash flows are ready to you, then you need to convert that to the present value, right? So today, after 1 year, you are going to receive 6 lakhs, right? So what is the present value today? So what you will be doing, present value, that either you can use the calculator or you can use a table value there, right? For the required rate of return of 15%, right? So what you can do is from the table value, R required rate of return 15% for n is equals to 1 year. Or the other way, what you can do is 1 divided by 1.15 to the power of 1, right? 1 divided by 1.15 to the power of 1. If you simplify, you will be getting the value as 0.8696, right? That is for first year 15%. What is the present value? That is 0.8696 multiplied by 6 lakhs. So you will be getting the present value of the future cash flow as 5,21,760, right? So the value what you are going to get, the present value of the future cash flow, what you are going to get is 5,21,760 value you are going to get. Similarly, if you want to calculate the present value for the second year, right? So you come to know the future cash flow for the second year, that is 7,20,000. Then you want to know what is the present value factor value, right? If you want to calculate, what you will do, 1 divided by 1.15 to the power of 2, right? That is 1 divided by 1.15 to the power of 2. If you do simplify it, you will get the value of 0.7561. So you will get the value of 0.7561. You will get 0.7561 multiplied by 7,20,000. If you multiply, so you will be getting the value as 5,44,392. So you will be get as the value as 5,44,392, that you will be getting the value there, right? Similarly, for the third year, if you want to calculate, so that is 1 divided by 1.15 to the power of 3, right? So you will be getting the value as 0.6575, right? So 0.6575 multiplied by 8,64,000. So you will be getting as 5,68,080, right? So then for the fourth year, so 1 divided by 1.15 to the power of 4, you will get the value as 0.5718. So 0.5718 multiplied by 10,36,800. So you will be getting as 5,92,842, right? So then on the fifth year, right? So 1 divided by 1.15 to the power of 5. So you will be getting as 0.4972, right? That is, you take this 0.4972 multiplied by 12,44,160. So you will be getting as 6,18,596, right? So this is how once you will be getting the future cash flows. So once you get the, this is what you get the present value of the cash flows. So once you get the present value of the cash flows, then add up, right? So you will get the total present value of the cash flows. Fine. So this is what we call as a total present value of the cash flows. Okay, this is clear. So this is about like only the present value of the cash flow. Then you need to know the present value of the selling price at the end of the 5th year. Okay, when you add up this 28 lakhs 45,670 plus the present value of the future selling price, so you will be getting the value of the firm there. Okay, now let's move on to calculate the present. That first you need to calculate what is the selling price at the end of the 5th year, right? So in this, when you talk about from the point of corporate valuation or from the point of firm valuation, right? You call that as a terminal value, right? So you call that as a terminal value for the firms, right? So for the companies, you call it the selling price of the company. Fine. That is, we use a terminal called as we use a terminology called as a terminal value. So terminal value TV5, TV5 nothing but why we take 5, because the prediction for the growth rate is 5 years. After 5 years, the prediction is going to be constant, right? If the prediction is going to be the constant, then there is no growth rate in the dividend, then we need to take that as a last year, right? So we want to take that as a selling price, right? So terminal value at the end of the 5th year is equals to future cash flow for the end of the 5th year multiplied by 1 plus G divided by R minus G, or K naught minus G, right? So future cash flows for the end of the 5th year, right? So if you just look at year 1, 2, 3, 4, 5. So 5th year, what is the future cash flows? We got is as 12,44,160. So this is your future cash flow. We are not supposed to take the present value of the future cash flows here, right? So we have to take the future cash flows. The future cash flow is 12,44,160, right? So 12,44,160 multiplied by 1 plus growth rate, right? So first 5 years, the growth rate is going to be the 20%, right? After 5 years, the growth rate is going to be the 10% forever till the company exists. So there we take 1.10, right? So 1.10 multiplied by 12,44,160 multiplied by 1.10, right? So then whole divided by cost of capital is 0.12 minus 0.10. So you will be getting as 6, that 3, 4, that is 684 lakhs 28,800, right? So this is where you will be getting the terminal value for the end of the 5th year. Now the terminal value, that is selling price at the end of the 5th year, what you are going to get. Now what is the present value of the firm today? To know the present value of the firm today, so what you will do is you have to convert the future selling price to the present value of the price. To convert the future selling price to the present value of the price, if you want to multiply, so what you will do, right? That selling price at the end of the 5th year multiplied by 1 divided by 1.15%, right? 1.15 to the power of 5. Okay, so there if you take it, you will be getting as 340 lakhs 22,799. Fine. So this is about the present value of the future selling price. Okay, so once you get this, right, so then you have to compute for the value of the firm. The value of the firm is nothing but present value of the future cash flows plus the present value of the future selling price of the firm, right? So present value of the future cash flow, the value what you got as 28, that is 28 lakhs 45,670, you got the value there, plus 340 lakhs 22,799, right? So when you add up, you will get a 368 lakhs 68,469 is what the value of the firm today, right? Based on this value of the firm, so you will decide as an acquiring company, you will decide whether you have to pay 368 lakhs, or above that you are supposed to pay the fair value, what is the value, or less than the value that you would like to pay. All depends upon the market conditions, and you will decide about what price that you are supposed to pay to acquire this target company, right? This is about like valuation of the firm of a target company. How can you value the firm? Based on which you will decide about the price, what price that you would like to pay for this firm. Fine. So this is about like question number 13, right? Any issues here? Can we go ahead to the next problem? If you're comfortable with this, now we'll move on to the next problem. Right. So now let's move on to the next problem here. So we have a next problem. Right. So let's look at the question number 13 here. Right. Sorry, question number 15. Right. So question number 14 is similar to this problem. So you can take that as in a homework here. So question number 15. Right. What is this question number 15? Let's try to understand here. Right. So let's first understand the given question of question number 15. Right, we have two companies again, like Alpha Limited is evaluating the possibilities of acquiring a Beta Limited, right? So Alpha Limited is acquiring firm and the Beta Limited is a target firm, and following are the data for the two companies, right? For the Alpha Limited and for the Beta Limited, right? So what is that it has been given is earnings after tax, right? So totally the free cash flows, what we call as what we have been looked into the previous problem, that is free cash flows for the firm, that is earnings after tax is 5,47,500 for acquiring firm, and for the target firm it is 99,000. Right. So number of shares of the outstanding shares of the acquiring company, we have 75,000 and we have a 45,000. Then we have earning per share. So earning per share is nothing but how do you get earnings after tax divided by number of shares, that is 75,000, that is 5,47,500 divided by 75,000. So you will be getting earning per share, that is 7.3, right? So then my total market capitalization is given as 1 crore. So how do you get this 1 crore? That is number of shares, right? So number of shares, that is 75,000 multiplied by market price. But still the market price is not being given here. So directly the total market value is being given to as 1 crore and 13,50,000 for the Beta company, right? So what is that we are supposed to calculate here? The first thing that we are supposed to calculate here is, so compute the value of the PE ratio here, right? So we need to calculate the P ratio, right? If you want to calculate the P ratio, the formula for the calculating the P ratio is the market, that is you need to know what you call as a market price, right? Market price divided by EPS. So in the given question there is a EPS, but market price is not been given, right? So when the market price is not being given, you're supposed to calculate first the market price. So once the market price is clear for both the acquiring firm and for the target firm, then it would be very easy where you can calculate the PE ratio, right? So before we proceed to calculate the PE ratio of the both the companies, let's first calculate the market price of the company, that is market price per share. So market price per share of the company is equals to market capitalization divided by number of shares of the company, right? So market capitalization, what is the market capitalization value for the Alpha Limited company? It is 1 crore, right? So 1 crore divided by number of shares is 75,000. So 1 crore divided by 75,000, you will be getting the market price of an acquiring firm as 133.33. That is 133.33 is the market price of the Alpha Limited company. Then for the Beta Limited company, right, the total market capitalization is 13,50,000. So 13,50,000 divided by 45,000 number of shares. So you'll be getting the market price of the share as rupees 30, right? So that is the market price. So once you get the market price for these both the companies, that is for Alpha Limited company and for the Beta Limited company, the next thing would be in terms of calculating the P ratio. And the P ratio formula is market price per share divided by PE ratio. Sorry, market price per share divided by EPS, right? So PE ratio equals to market price per share divided by EPS. Or you want to know the market price, one thing, right? The alternative way of calculating the market price is take the product of earning per share multiplied by P ratio, right? So either you multiplied P ratio multiplied by EPS, so you will get market price per share, or right, the total market capitalization divided by number of shares, you will get the market price per share. Either of these two things you do it, you will get market price per share, right? Now let's calculate the EP ratio for the both the companies, that is Alpha Limited company as well as for the beta limited companies, right? So when you come for the alpha limited company, if you want to calculate the P ratio, the market price, just we calculated the market price, that is 133.33. That is 133.33 divided by EPS is 7.3, right? So you will be getting the P value for the alpha limited company as 18.26, right? So you will get the value as 18.26. Then similarly for the beta limited company, the market price per share is 30 divided by EPS is 2.20. 30 divided by 2.20, you will be getting a 13.64, right? So that would be the P ratio of the target company, right? So first sub question is calculate the P ratio, as we have calculated here the P ratio for the alpha limited as well as for the beta limited companies. Then compute the synergy gain, right? So when you want to compute the synergy gain, what the second sub question is, compute the value of the synergy gain by considering increase in the earnings by 2.50. I think this value may not be updated in your question paper. Kindly update the second sentence in your question paper, that is by considering increase in the earnings by 2.5%. Okay, that is after combining both the firms, right? When both the firms start working, there is an increase in the earnings by 2.5%. Okay, so what is the synergy gain? Synergy gain would be, right, so combined earnings with synergy and combined earnings without synergy, right? So combined earnings with synergy, that is, what is the combined earnings? Combined earning as it given in the question, that is earnings after tax, it is given in the question like 5,44,500, like, so 5,44,500, where it is been given, right? It is given here it as a 5,44,000, and in the here it is given as 99,000, right? So these two things to be taken here, right? So that is 5,47,500 plus 99,000, right? That will be giving the total earnings of both the companies multiplied by that is 2.5. That is 2.5 is the synergy. That is 2.5 when you write 1 plus 0.025. When you multiply 1.025 with the value, so this value minus combined earning without synergies. Combined earning without synergy, that is earnings of an acquiring firm is 5,47,500. Then earnings of the target firm is 99,000, right? So when you simplify this, right, so you will be getting the synergy value as 16,163, right? So 16,163 you will be getting the value here. Okay, this is about like second sub question. Fine. Then coming to the third sub question. What is the third sub question? Calculate the cost of merger, right? So what is the cost of merger? Cost of merger is how much is the cost to the company, that is for an acquiring firm, because cost can be calculated when you when you subtract the value, right? When you acquire acquiring firm, you are getting that value, that is the asset, right? So how much you are paying, how much is the asset that you are going in return, how much is the asset you are going to get in return, right? And whether is there any cost, then how much is that cost, is what we call as a cost of the merger, right? So cost of the merger, so cost of the merger, if the beta limited is set paid cash of rupees 40 per share, what they say is in this merger they are paying for a cash of rupees 40 per share. So how many number of shares are there for a beta limited company here? How many number of shares are available for the beta limited company?
75,000. Sorry, 45,000.
45,000, right? 45 into 40. That would be the cost of the merger, right? 45,000 shares. For every one share, right, acquiring company wants to pay rupees 40 rupees per share, right? Rupees 40 per share multiplied by 45,000 shares, right? So this is what you are being paying. In return, you are getting a company worth of 30,50,000, right? Then what is the cost of the merger? This is what we are trying to do in the sub question 3. Right, so cost of the merger. The cost of acquisition is for Alpha Limited when they pay rupees 40 per share in the cash, right? So cost is equals to cash paid. What is the cash paid here? So cash paid is rupees 40 is a cash paid, rupees 40 per share multiplied by 45,000 number of shares, right? So this is 45,000 number of shares multiplied by this minus market value of the target firm, right? Market value it is been given here. If you just look at, so market value is how much? 13,50,000. In return, you are getting a value of the firm which is having a value in the market of 13,50,000. So this cannot be a cost to you. This is a profit, right? So you will take out the benefit, right? So cash you paid 18 lakhs you paid for acquiring the company. In return, you got 13,50,000. In return, you got the value, right? So 18 lakhs minus 13,050,000, right? So how much is actual cost of acquisition is only 4,50,000, right? So 4,50,000, fine. Okay. Fine. So that is about like third sub question where the cost of the merger is only what you call as a 4,50,000. Fine. So next would be the cost of acquisition. Now cost of acquisition, if the Alpha Limited offers one share, right? So if Alpha Limited offers one share, right, for every 3 shares of a Beta Limited, right? So that is what they say is first in third sub question what we did is we calculated what is the cost of merger when it is a cash, right? So we are paying rupees 30 as a cash. Then what is that cost? Fine. So now what is that we are trying to do is we are trying to give in the form of like stock, right? So we take 3 stocks of the Beta Limited company. In return, we will give 1 share, right? 1:3 is the ratio here, right? Then what is the cost of the merger, right? So cost of the merger when you go by exchange of stock, right? By exchange of cash, the cost of merger is 4,50,000. By exchange of stock, what is the cost of merger, right? To calculate this, we use a formula that is cost is equals to alpha multiplied by market value of the combined firm, right? So that is alpha is here, alpha multiplied by market value of the combined firm minus, right? So we have a minus sign here, then minus market value of the target firm, right? So market value of the combined firm, it is been given in the question, market value of the combined firm, right? So that is absolutely not an issue here, right? So then we have a market value of the target firm is given as 13 lakhs 50,000. Okay, so that will not be an issue. What is this alpha value? How do you calculate this alpha value, right? So look at here, the alpha value formula is been given here. So alpha is equals to number of shares issued to the target firm, right? How many number of shares that you are issuing to the target firm, right? So total number of shares of the target firm. What is the total number of shares of a target firm? How many number of shares are there for a target firm? How many number of shares? If you just look at here, 45,000, right? So 45,000 shares you have divided by 3, right? Because the ratio is 1:3. So you will be getting 15,000 shares that you are been issuing. You take 45,000 shares in return. So you will be getting only giving back only 15,000 shares, right? So take 45,000 shares and in return give 15,000 shares, right? So that is number of shares it is 15,000. 15,000 divided by number of shares of acquiring firm, that is not going to change here. It is shared as 75,000, right? It is shown as 75,000. That will be the same 75,000 plus 15,000. The alpha value which is going to get as 0.1666, right? So you will be getting the value as 0.166. Fine. So this is alpha value. So alpha value multiplied by market value of the combined entity, right? So combined entity here would be like 1 crore plus 13 lakhs 50,000, right? So 1 crore by 13 lakh 50,000, right? So plus the synergy benefit of 0.025. So you'll be getting the value as 1 crore 13,66,163, right? Multiplied by alpha value minus the market value of the target firm. Market value of the target firm is given as 13,50,000, right? So that you take it. So simplify this, right? So you will be getting the value, what we call as the what is the cost of acquisition, right? Simplify this, you will be getting the value for this. Okay, got it? So can you simplify and say me what is the value here? Cost of acquisition, what is the value that you are going to get? Okay, how much is the value that you are going to get there?
Five lakhs 36,783.06.
5 lakhs, huh?
Yes, sir. 5,36,000.
Okay. 5 lakhs 36,000.
36,000.
Okay.
783.06.
783, right? Now which is more beneficial, whether by stock is more beneficial, the cost which is comes to be 5,36,000, by the cash it is 4,50,000, which is more beneficial, which is more
Cost.
beneficial, cost by cash, sorry, merger by cash or merger by stock is more beneficial?
Merger by stock.
Merger by stock, the cost would be for you 5,36,000. It is more costly. When you go by cash, the cost of the merger would be only 4,50,000. If you acquire the firm, how much is the cost, right? How much is the burden to you? The burden is only 4,50,000, right? The debt is only 4,50,000 to you, right? If you go by the stock, the burden would be 5,36,000. Which is the burden? Which burden is very less? Right? Lesser the burden, lesser is the cost, more profitable, right? So if you go for a higher burden, it is more costly, right? It is more costly, again it will affect your earnings, right? So 4,50,000 is less cost, whereas 5,36,000 is more cost. So 5,36,000 is for a stock, by exchange of stock, right? The 4,50,000 is by exchange of cash. So it is always beneficial to go by cash, not by the stock. If they ask you to make the decision there, so you can say that the merger by cash is more beneficial than by merger by stock, right? Agree you all? Yes. Any issues here? Do you all agree with this? Right? Shall we go to the next problem here? Okay. So next problem we'll take it up and we'll close this valuation. The next chapter, when we start from the next week, so we'll start with a fresh chapter, right? Just go through this 16th problem here. So we have a relevant financial data of the two companies. One is what we call it as a day limited, right? The other we have a night limited, right? So this is two things. So market price is given as 65,000 for day limited and 30,000 for the night limited. Number of outstanding shares is 8 lakhs, right? Then 5 lakhs. Okay. Market capitalization is 5,22,000 and you have a 1,50,000. Fine. So now let's understand who is going to acquire other firm. The merger is expected to bring a gain which have a present value of 1,20,000. So what do you understand by this? What is this exactly 1,20,000? 1,20,000, right? It is showing. What is this? It is a synergy gain, right? So synergy gain of the merger is going to bring the gain of the merge firm by 1,20,000, right? Day Limited offers 2,46,000 share in exchange for 5 lakh share of the Night Limited, right? So Day Limited is an acquiring company which is offering 2,46,000 shares, right? So what is the actual number of shares of a Night Limited here? Actual number of shares of a Night Limited is 5 lakhs, right? So Day Limited wants to acquire Night Limited. So take away all these 5 lakh shares and return you 2,46,000 shares. Fine. This is the share in form of cash. The merger with respect to, sorry, not cash, the merger with respect to stock exchange is been given, right? And the Night Limited, assuming that the market value of the two firms before the merger announced are equal of the present value of the separate entities. Calculate the net present value and the for Night Limited and Day Limited. What is the net present value? Nothing but the gain. Actually, we talk in the form of gain there, right? So to calculate the net value by taking into the synergy gain, what is the value for the firm, right? So when we come across the concept of net NPV, so we have to use this methodology. So first is what we need to do is calculate the combined market value of the combined firm. So market value of the firm, it has been given, yes. So 5 lakh 20, that is 520 lakhs for acquiring company and 150 lakhs for target company. That is 520 plus 150, right, plus the synergy gain of 120. Total market value with synergy comes out to be 790 lakhs, right? Now what is the proportion of gain to the both the companies? Now total value, it is going to be 790 lakhs. How much each company is going to get benefited out of this merger, right? So here what we'll do is compute the proportion of shares of the firm in the proportion of merger value, right? So what we'll do here, first, proportion of share. What is the proportion of share after the merger, right? So for the Day Limited, it is acquiring company. Number of shares of acquiring company after merger, right? So after the merger, number of shares is 8 lakhs. It is the same 8 lakhs here. Then total number of shares of after merger. After merger, what happens? 8 lakhs of acquiring firm plus 2,46,000. What is that the company is saying? Right, before merger, the Night company has a 5 lakh shares, right? So they will take away the 5 lakh share. In return, they will give 2,46,000 shares. And the proportion of shares after the merger for the Day Limited, that is acquiring company, comes out to be 0.765. Okay. Then for the Night Limited, that is target company, number of shares of the target company after merger is 2,46,000, right? So the total number of shares after merger 8 lakhs plus 2,46,000. The proportion value comes out to be 0.235. Right, for the acquiring company, that is 0.765. Fine. So this is about proportion. Now let's look at the gain. Right, so computation of gain to the shareholder, that is what we call as a NPV, right? For the Day Limited, is for an acquiring company post merger market value of the firm. So market value, as I said, we can calculate by taking number of shares, right? So or what we can do, total value of the combined firm multiplied by proportion of shares, right? So total market value of the combined entity is 790 lakhs, right, which we have calculated, multiplied by proportion of shares 0.765. We get the total merger value after merger is 604 lakhs. So pre-merger market value, which has been given in the question, that is 520 lakhs. So what is a gain to the shareholder is 84.35 lakhs is a share. It is a gain to the shareholders of the acquiring firm, right? Similarly, if you want to calculate what is the net present value for the target company, right? So post merger market value of the firm is equal to total value of the combined entity is 790, which we have been calculated the first sub question, multiplied by proportion of the shares of the combined entity, right? So that we got it as a 0.35, right? So there, if you multiply, you will be getting it as 185.65 lakhs multiplied by pre-merger value is 150 lakhs. So you'll be getting as 35.365 lakhs. This is the net present value for the shareholders of the acquiring company and the target company. Right? Both the firms has a positive net present value, which shows that merger is beneficial for both the companies here. Okay, this is about the 19th question. Fine. So sorry, 16th question. So by this we will be closing the valuation, that is model 3. In the next class we'll start up with the next topic. Okay, so by here we'll stop the discussion. So in the next class we will take up the next topic. Okay, so thank you.
Thank you, sir.